Like I said, I'm Lucas. I'm really just happy to be up here talking to members of the society. I've attended a lot of these, so it's kind of fun to be on the other side of this. We're going to speak a little bit about data analytics in our current roles, and then we're going to touch a little bit on the future of that. Here's our agenda because we're all in businesses and this is a meeting. We're going to do those introductions. We're going to talk about our background. We're also going to talk a little bit about our firm, so you get a little bit of the context of how our jobs fit into those firms. We're going to talk about the data analytics environment, and then also sort of the data analytics sort of collection of the data and then the processing of it. And then we'll flip it over to David to talk about the interpretation of that. And then, like I said, we'll talk about that future of data analytics piece, which we'll touch on AI and machine learning. We will leave enough time for a little Q&A at the end. If you have any questions throughout this presentation, though, feel free to ask. Just raise your hand and we'll stop. This will be pretty informal. So my name is Lucas Bunting. I got a BA from Bethel University, Economics and Finance. Took very little math classes, so you don't have to be a math whiz to do this, though it helps. I passed all 3 CFA exams, but have not quite met the experience requirement for it, so I'm not a charter holder yet. Early next year would be the earliest time I can apply for that. My work history, I'm currently working at Mairs Power as a quantitative analyst. I'm also moonlighting on my nights and weekends for Bethel University for their student managed investment fund. I work with another investment professional, and we sort of help mentor students and help them make investment recommendations and run a firm. Before that, I worked at Wells Fargo Private Bank. I will pass this over to Joe to introduce yourself.
All right, well, my name is Connor Joe Lewis. I go by Connor Joe. I have a BA in both mathematics and statistics from the University of Minnesota Morris. So I did take a bit more heavily in the math and in stats side of things. And then I pursued a biostatistics degree at the University of Minnesota. I worked a lot with clinical trials at that time, and after I graduated, I realized I wanted to go in a little bit different direction and enter industry. I've been working at Securian Financial ever since I graduated, and since I've been there, it's grown. Their data science area group has grown a lot, so I'll talk about that in a little bit.
Perfect. David Slegh. I, similar to Lucas, was probably bred into this more than born into it as far as education goes, so have a dual major from University of Minnesota Duluth in finance and then management as well. I am a CFA charter holder, as well as I do have my CAIA charter alternative investment analyst as well. My history is on the wealth management side, is where I started in the industry, working with high net worth individuals to build customized portfolios, and then I've kind of evolved into more of the quantitative role. Obviously, with the firm that I'm with right now, Quantitative Advantage, we do a little bit of quant type of analysis. That's my background.
Oh yeah, sure. So I work here on the 15th floor, Mairs Power. We have 3 mutual funds and some SMAs as well. 9 billion AUM. Obviously that fluctuates around a little bit, but 43 employees, and the firm is 100% employee owned. It's established in 1931, but don't worry, none of our current members have been here since then, so I'm a little bit younger than that. It focuses completely on companies that are headquartered in the upper Midwest, specifically Minnesota, though we're not restricted to that. My team is just me. There are about 10 other fundamental analysts, but they severely outnumber me, and I work directly with the CIO, and together we are the total quant force there. The data sources that I use are FactSet, Bloomberg, and Morningstar. With FactSet, I use alpha testing and PA3, which are just different tools that they have for back testing and ways to slice and dice ex post and ex ante performance. And then I also use a little bit of Bloomberg and sort of the languages that those use in the background to integrate with Excel.
All right, great. I'm at Securian Financial, which is just up the street here. We're actually the 8th largest insurance company in the nation, the largest insurance company most people have never heard of. It's one of our taglines. We now have over 19 million customers and are extending into Canada, almost 1.2 trillion of insurance in force. And we used to be, or we are still, also known as Minnesota Life. In terms of data analytics, like I said, we've grown a lot since I started. We do have a digital analytics department on the marketing side of things, but in terms of the business side of the company, we now have 6 members and comprised of 2 data scientists, 1 analyst, and a series of actuaries, one of them being our director. And we're continually growing and trying to push forward more investment in our data-driven decisions. And then we use a lot of our own customer data, which I'll talk about a little bit, the challenges that go with working with your own customers' data and personal identifying information. And then we do have a lot of external purchases of data, different companies, especially within the business area I work in, which is pension risk transfer. And then we use programming language such as R, starting to use a little bit more Python, a lot of SQL. Throughout the company, there's tons of different platforms that are used, business objects, etc. And then Tableau is used with a lot of our marketing teams as a visualization tool, thank you, for the data analysis that we end up doing.
Perfect. And Quantitative Advantage, we're an asset management firm founded in 2000. Best way to think about us is that we focus on tactically managing global portfolios, and we do that through purchasing exchange-traded funds. So we don't do individual equities, we do groups of stocks when we're purchasing stuff. We run separate accounts, so individuals see trades in their individual accounts. And we have about 1.4 billion. That breaks down to 450 roughly in assets under management, and then the remaining amount is assets under advisement or assets that follow our models. We are relatively small, 16 employees. On the team that I work on, there's 3 of us in the portfolio management group, so an even smaller group. Right now, what happens is we do manage portfolios from a team perspective, so that's something where we're all giving input to figure out at the end of the day how do we want to position our global portfolios. And we do receive support from other departments as needed with marketing and other types of things. Data sources that we use primarily, we're pretty heavy Bloomberg users. We do use a little bit of Morningstar data as well, but a lot of what we do is in MATLAB. So we'll download the Bloomberg data and then do our analysis in MATLAB. So when we start to look at what we use for data analytics, it's primarily MATLAB, and then Bloomberg does have a vquant function that you can do some programming and Python-based stuff too. So that's something that we are in the process of starting to implement as well.
Okay, so I just want to give even a little bit more background. So I'm coming more from the insurance side of things, working a little bit less closely with investments, although I have done a little bit of 5-10-year projections for investments within our 401k options. That being said, overall, firms are at different levels of using data, different size firms or companies, and maybe some that have been investing in data-driven decisions for years using modeling, and some that are just getting started now. And I've seen everything from one-man teams to multiple teams within a company of 10 to 20, like the larger insurance companies I've seen. So, but I've also seen larger insurance companies that are still with 1 or 2 analysts or data scientist type positions. And the biggest thing I've learned is that data analytics is a team sport. So especially in where I work, we're working towards growing these types of groups. I work for this actual research center of excellence. So people from different business units come to our group and say, hey, we have this project that we want to do. How do we get there? Here are our data sources. This is like the main focus. What's the next step? What's the modeling? And we work with them to maybe create a model or some type of output tool that they can use. And what I've noticed is there's this need for, the overall business leader, the decision maker. And then of course you have a project manager to keep everyone on the same page and keep it moving. For me, the subject matter expert or person of that nature, comparable industry position, is an actuary. That can be different, of course, in different business areas. And then a data scientist or analyst or something of that nature. And then for me, it's important, so we have tons of different storage areas for data. And this is a lot of companies, maybe they've been collecting data for years and they put it in all these other spots, and someone started collecting it in an Excel spreadsheet over here, and they stored it here, and then another business unit created a data mart or warehouse over here, and we have to figure out how to combine everything together and use. So I work very closely with my main man, my left-hand man, David. His name is David, and he knows the data that I work with so well. At the back of his hand, he's been there for over 25 years, and he was there since the inception of the database. So working with someone that knows the data ins and outs already is ideal, and it's been a big help for me. And then once you create this model and this tool, a business analyst to implement your tool, to run your tool, to take it to the next level. And then also business leaders to continue to support and invest in their associates to make these data-driven decisions. It's huge, yes.
So quick question, who's usually the decision maker?
So in my area, for us, it's the VP of our area, or like an actuary, it's a director of some sort.
Okay.
So that next level step. So we have our team, and then we'll present them with our findings, and do some testing, extra testing, and then they're like, okay, we sign off on this model. So we do a lot of peer review between data scientists, so then they'll, so because we want everyone to have faith and trust in what we're doing, with what the data is saying, which I will talk a little bit about on the next slide. So this data collection process, and for me it's not just the collection of the data, it's the storage of the data, it's making sure that you're ready to do the types of analysis that you want to be doing. And my business area, we have a lot of internal customer data, so 401ks or people that are in some type of annuity program. I work with pension risk transfer, so we are bidding on companies that want to offload their pensioners, and we have to make sure that we are modeling their mortality rates correctly. So we purchase outside data, we've made models on these outside data, we use SOA recommendations as well, do some type of blending to project how long everyone is going to live, and then make some type of offer on these bids. And you want to be correct. It's hard to, you want to win the bid, but also if you win, maybe you're saying that people are going to be dying too soon. So that would be bad in the long run. So part of this data collection process is there's going to be personal identifying information. We need to know where these people live, we need to know their birthday, we need to know most of their demographic information so we can be solvent and keep our business going in the right direction. And with that issue comes the data storage solutions. So I work a lot with law and compliance to make sure that we're meeting all of these security clearances. Maybe we need to do some type of encryption so we can store their information to make sure if anyone would ever get into our system that they're unable to access someone's personal identifying information. And there are various data storage solutions. There's the easiest one, if there isn't personal identifying information, people might even store stuff in spreadsheets right now. Not recommended, but it's definitely done. And then the next step is some type of data mart that might be called, or data warehouse. Technical term might be like a SQL server, where you're able to query against the databases, and it's somewhere in-house on a server. And then there's the next step, which is this data lake type thing, which is essentially you can think of it more of a pool of data, a little bit less structured, but there's still security clearances that people can access throughout the whole company. It's easier to keep all of the different data sources straight and to be able to join them together as needed. So if you contact us, you're like, I want all of my information, which now if you're a Californian, you can now do that. The company has to be able to provide any piece of information on you to you. So being able to query against one database and bring that all together is the way that companies need to be heading. And then a last data storage solution, which I've seen at various companies. In my internship, I saw this, is using something like Amazon Web Servers or some type of cloud storage. And then I just want to touch on like challenges for companies at various stages of data collection or in this data process. So companies might just be starting this whole data collection or capturing of their customers' information or maybe even their business's progress. And for that, you need to be future thinking, analytics based. What are all the variables that we're going to want or possibly need? And what is the best way to organize them and to store them? For example, we have data where there's a participant and maybe their birthday is 5/14/1963. But then we find out in 2 months that their birthday was actually not 5/14/1963, it was 6/14/1963. How do we make that change but still keep their previous information? And then you start to have, you already have 10,000 customers and you have another line, maybe another line and another line. Is that the best way to go? Or is it better to go horizontal, making decisions such as that? And then also let's do some pilot studies. Let's do some small studies on our subset of data that we do have to see where it could potentially take us. To see okay, we think this is true, it's trending in this direction, but is it actually the case? Is it actually what's going to happen in the future? So you have a base, you have, that's something that you can take to a business leader, this is what we believe might happen. Please invest in this so we can continue to see the study work through, and this is the benefit to you. And then other companies that maybe are in the later stages, I said late stages, maybe it should be just further on, because I never think you are in a late stage of collecting data. You should consistently be collecting a lot of this data. And here we get to the point of, okay, this is what we believed has been true for years. People act like this. If you give them these investment options, people tend to act like this. At least that's what we think. But is that true? Can we look at these data and will that tell us that that is true? That these beliefs that we've had for however many years is actually what's happening? And yeah, maybe it's true, and that's great. It's difficult when that's not true, and you have to have those discussions. And we have had these data, and we have 10 years worth of experience, and people are actually acting different than we expected. And that's something that I preach a lot about, is we might go around talking about these hypotheses and things that we believe have been happening, and now maybe you have data to prove it, and that's great, and then you can really, really start pushing that, because you really know. You don't have to go into a meeting saying, we think this is what's happening. The power of data, I think, is within that comparison, which isn't always versus. Sometimes it's together. And then we have priority of analysis topics. It's all going to be what if we do this? What if we do this? Can we do this with the data? Can we slice it this way? Can we then do it this? And yes, all of those are options, but we only have so much manpower. So let's figure out what's our priority, what's the next step, which one is going to have the most impact dollar-wise for a company, because let's be honest, that drives every business decision. Is this going to make us more money or keep us solvent, keep us from making some type of mistake? So let's put these in a priority list and work our way down and build towards the ultimate goal. So that's all with internal data storage and what to do with data if you have it, and just the questions to think about as you start on the process of some type of analytical project. And then there's, of course, like I said, we do get external data. We've purchased it from other companies. I know some people in different business areas have scraped or taken data from web sources as well, if we're able to use them based off of their privacy settings. But the other way to do it is, I think you're going to talk a little bit about capturing external data, and I'll hand it over to you.
Perfect, yeah. So what Connor Joe just did for us here was basically tell us all the why of why it's important, right? And then now I'm here to tell you the how and so what I'm going to do is walk you just through an example. It has nothing to do with anything, mortality tables, 401k, nothing like that. It's a completely separate example, but it's something that maybe some of you might be interested in. And so basically the process is, you collect the data, you scrub it, you analyze it, you visualize it, and then you either present it or make a decision on it, and then it actually circles back to what Connor and Joe said, and you have to find out a way to store it, but then monitor it going forward, make sure that there aren't any material changes to the integrity or structure of that data set. So the first one, collection. You can either internally house or collect this data, and that's going to take 15, 20 years to do it. If you record it yourself, or you can extract the data from an existing database, which for investments is usually what we end up doing. We can take it from FactSet, Bloomberg, or an alternative data set provider. And so what I did, our company was interested in Morningstar Moat and the star ratings for individual companies. So we wanted to know, for our universe and for our market cap range, does the moat rating and do the star ratings actually work for us? And so I pulled all that data from Morningstar. It only goes back to 2002, but it's monthly. And you can, I kind of did a little snippet for you here. And, wide moat, narrow moat, or no moat, those are the only three, and then there's the 5 stars. After that, I had to scrub it a little bit. If you give the computer wide and narrow, it's going to be like, so I had to figure out a way to transform that data into numerical data that it could actually use in a back test and could perform calculations on it. Other examples of this, though, a lot of data sets will come with holes, so especially if it's older, and you're trying to get monthly information. Some months just might not have been reported for whatever reason. Maybe they couldn't find it or whatever. So I pulled something from U.S. Bank. It was like returns from 1970 something. They were monthly for a specific investment. They didn't have it, but they had quarterly, and they had 1 month in that quarter, but not the other 2. It doesn't really matter exactly what those 2 months were. If I had the quarterly number, I could linear interpolate those, and then I could use it in my monthly model, because it eventually led to the same outcome. So the data won't always be perfectly exact, but if it does, in effect, get you to the same solution, you might have to scrub it that way as well. You might have to transform the data. This could be a linear or geometric or logarithmic. Kind of depends, like market cap, for example. That may be something that grows exponentially, but the factors that influence investment performance may not. So a very common transformation of market cap data is to take the natural logarithm of it. So for me, it was actually very little scrubbing. All I did was just change these to a numerical form, and I won't get into the details of what I did, but that's a way I could then upload it into the tool that I use. So the analysis, you just perform the calculations on the data set that provides answers to your question. That is the biggest oversimplification, I think, in this presentation. But that's essentially what you're doing. It could be anything, so I'm not going to give you a ton of examples on what you could do to analyze the data. But what I did was I uploaded that clean data set to FactSet, and I used a screening tool. The screening tool is a super powerful tool within FactSet. Bloomberg has it too, and you limit a universe based on different metrics that you can think of, right? But when you combine it with their backtesting tool, what it does is the backtesting tool tells you when to run that screen so that you can shrink down your universe and calculate those metrics on a specific day. And they can do it iteratively over a very long period of time. And then they can use a ranking system to then pull more data from other databases all into one thing. And I'll get into that just a little bit. But basically what we're doing with this is we want to know, do the moat ratings work, do the star ratings work? And that's pretty much all encompassed in this IC, or information coefficient. And if you haven't cleaned the dust off your level 2 and level 3 textbooks for a while, the information coefficient is in the fundamental law of active management, and that is basically how good you are as an investor, how much knowledge you have. it's a factor in outperformance. But the way that we calculate it is that it's just the correlation of the information you know today and the factors that you calculate today. It's the correlation between that and future returns. If you know something today and that gives you higher future returns, you should have a higher investment or information coefficient, and then that should be something that you would want to pay attention to. So you can calculate a t-stat with it, which you can with most numerical data, and then you can then determine whether or not this is a statistically significant factor that you're looking at. And so our two factors were moat and star, and then we combined them. Okay, if it's got a 5-star rating and it's a wide moat, in Morningstar language we have found the holy grail, right? And so that should have a really, really high ranking, and that should be telling us to buy that. The other reason you sort of do this is because it mimics portfolio creation. I'm going to skip that for now. But back testing in this way makes it so that it's actually useful to people who create portfolios is the main point of that. So after that, we want to visualize the data. So we've calculated all the returns over the specific time periods that we had. And we know all of the moat and star ratings, and we know all of our investment information coefficients over the different time periods. But what that tool will give you is just the number for the time period and the number average overall. That is super unhelpful to anybody that's using the data. So what we did then was show you what that t-stat number was over time, and then we put our significance level on it. So you know that most of the time, anything above that line, most of the time that was something that was important to know. And then after that, you interpret the decision, or you interpret the data and make a decision. When you summarize it really well, this can be a very easy step. But if it's a much more complex question and something that has to deal with mortality tables and the people's lives a long time in the future, this becomes a very hard step. But you basically present your findings to a decision maker, as Connor Joe talked about. But what I did is just presented the findings to the investment committee. We made appropriate changes to the investment process and implemented a continuous monitoring of the data set as it's updated. So I go and I check and I make sure that the conclusions that we drew continued to be true. After that, we got to find a way to store it, and we put it on FactSet servers. That's really nice. It's cloud-based. I also downloaded it and save it on a shared drive. Multiple places is sometimes overkill. I like it because it's just a little bit safer, but it also can be very confusing. Did I save that on the cloud, or did I save that on my personal drive? Did I save it on both? All right, I got this file now in 2 different places. Which one's right? Which one's much more updated? So if you save it in multiple places, it's theoretically safer, but it can also be very confusing if you don't organize it well. And then also this is an important step just because in our code and standards we need to make sure we can replicate past recommendations. It's just figured out through the CFA Institute a bone there. And then so after that, yeah, I'm just going to go ahead and pass this along to David unless anyone had any questions on the process.
Perfect. So as I was starting to think about interpreting and integrating data analytics into a decision, at first I'm like, okay, this will be easy, and then I started to realize, wait a second, it is all in the eye of the beholder. So that brought me across this optical illusion, which I'm sure many of you have seen before. This can either be a young lady right here looking off to the side, or it can be an older lady with the chin right here, mouth, and this being the nose, looking down. And it all depends on how you look at this optical illusion as to, and how you approach this optical illusion as to what you see. So one quick disclaimer, only after choosing this as an example did I look at the history of this to find out that it was on a German postcard in 1855 that an artist illustrated this, and then there was a cartoon rendition, and this is what you see today, that was done in 1915, and it's titled "My Wife or My Mother-in-Law." So that in case my wife somehow gets a hold of this recording, that was after the fact. It wasn't something that I chose to begin with. One other thing that I ran across that I thought was very interesting is Sir Arthur Conan Doyle with the quote of, "It is a capital mistake to theorize before one has the data. Insensibly, one begins to twist facts to suit theories instead of theories to suit facts." And that's something that what you'll find is that everybody has a different way of interpreting data. Sometimes if you are very good with the data analytics and you have just one specific problem, that's going to be very straightforward and you can come to a direct conclusion from there. In other situations, for example, let's say hypothetically that you're making a decision on what sector you're going to overweight in the S&P 500. You may start to look at, if you were to use risk-adjusted returns, you may start to rank sectors or create a hierarchy of opportunities. But there can be many different things that is influencing that hierarchy of opportunities. If it's risk-adjusted returns, you could see tech ranked right next to utilities, but they could be there for different reasons. Maybe tech has been experiencing a lot of volatility and therefore it falls down in the rankings because when you risk adjust, that can affect your rankings. Or it could be that maybe utilities has less risk relative to the return that it's getting, but there's all sorts of things that can really influence what you're seeing in your hierarchy of opportunities. And so that's where I get to the fact that data interpretation, at least from my occupation and where I stand, is a little bit more of an art as opposed to science. There's going to be plenty of challenges or problems that you approach that it's more the science side, or from my side, it is a little bit more of the art side of having to understand. At the end of the day, I'll just jump to this last one. You need to identify a narrative of what your data analytics is telling you. And the reason that we focus on identifying a narrative is because at that point in time, we have to understand what's driving our data analytics to come to this result. Is it something that you may have interest rates influencing a sector decision? And if you're having interest rates influencing what sectors you're overweighting or underweighting, the last thing that you want to do is have all of your outcomes in one basket based on one underlying trade, because bunching trades together is not a diversified portfolio if you have the same outcomes that are directly related to the same underlying input. The point that I did skip over is using data analytics is similar to using a roadmap. I said Google on there too for those of you who use Waze or those sort of things. But the way that I think about this is that if I pull up on my map to drive to St. Paul this morning, I pull up on my map, it starts giving me directions on how to get here. There's a couple things, I'll follow it. But especially with Minnesota roads these days, there's definitely some potholes. So I'm going to be aware of where I'm going and adjust as I'm driving based on traffic, based on potholes, based on other road conditions. I'm going to adjust how I'm driving. So as I'm using my data analytics and getting the output from these, that's what we really focus on as a firm, is in my role, is interpreting the data, but then also understanding how does that fit into the broader context of things from a portfolio standpoint, but then also from what is the market dialogue that we're getting and what's the market narrative. The last thing that we said that we talk about is the future of data analytics. So when we think about what does the future hold for data analytics, AI is one of those things that you hear right away. AI, or sometimes machine learning, is slightly different, but it depends on the terminology. But so I'm sure you guys have plenty of good opportunities or examples of how you can utilize AI to become more efficient. But the one thing that I want to emphasize is, I'll take a little bit more of the pessimistic approach, not saying that there's not good implementation or good usages of AI, but really one of the things, at least from our firm perspective, when we start to think about AI, we have to understand how it behaves. And a great example is that there was recently a research report that came out, not about finance, but this is just about AI in general. And what it was titled is Artificial Intelligence, Algorithmic and Pricing and Collusion. And what they found is that when you use artificial intelligence and you deploy it to price products, in this case they were going out and just pricing hypothetical products. They deployed AI number 1 right here, and it went out and started pricing products. Then they deployed AI number 2 right here, and that was pricing products alongside AI number 1. even though they didn't direct these to start to collude together, what they found at the end of this research paper is that though the AIs started to realize that the best way to price products is not to collude directly, but to make sure that they're not the most competitive price out there, because there's an opportunity for margin in there. So you start to see these things, unintended consequences, but you at least see some collusion between those. So what happens when you start to think about AI from the investment process? That's what we start to think about is, what are the unintended consequences that you get, and you have to understand kind of how it behaves within its shell when you're deploying it. If it was just strictly for an investment decision, at the end of the day, you want to really understand how it's going to behave making that investment decision. Now, there's plenty of other challenges or problems that you'd face that you can definitely implement AI, I think.
Yeah, and just to piggyback off of that, I was also reading something, and the article was talking about how AI is just such a black box, but it needs to be. And I am in no way qualified to tell you anything really in detail why this is, but basically the article goes on to say that the more you try to make the whatever model you're using tell you how it reached that conclusion, the less accurate it becomes. So if you have it like telling you different data points that it's using, you can actually see its accuracy declining the more and more granular it lets you know. So it is, seriously, I have no idea why that is, and I wish I did. I think that would require in-depth knowledge of programming and AI models, but it is something that is pretty interesting.
If you want me to.
Well, that would be fantastic. Yeah.
Okay.
Yeah. Go
Yeah. So I mean, one of the biggest differences between AI and machine learning, like machine learning is like a subset of AI. AI is, you know, the human aspect, like getting your machine to act like a human. So with what you said at the beginning there, like it's a black box, but it needs to be. One portion of that is like our heads are black boxes. Like everyone, like we're making decisions. Yeah, we have some information between us, between what we're going to do, but ultimately, like I don't know exactly what decision you're going to make. If we're driving around the street, we can use that. Like I don't know what that next person's going to do. There's what I would do, but they might not do the same thing. In terms of it telling you data points. So another way to look at this, if you have, let's say you have data, you want to slice your data in 30, let's say 100 different ways. And if we are looking for some type of p-value less than 0.5, whatever it might be, and you test every one of these 100 ways, you're essentially fishing for a p-value, and you're going to get one, probably, at least 5% of the time, because that's how p-values work. So that's like overusing the model, right? Like trying to find something that's not there, which is, I think, the easiest way to describe it in terms of like a statistical standpoint. For like an AI algorithm, the same thing, it acts the same way. So like if you try to look at it, peek at it more and more throughout the process, the more likely, like you said, it probably will start acting differently, or maybe less how you would expect it to, or become more aggressive in some shape or form. Similar to like if you have some type of clinical trial. So that's my background is biostats. But if you have a clinical trial and you have two drugs, A and B, and you want to see which one's doing better, if you are able to peek at the data throughout, you have to actually change your significance level, because you might find something that isn't actually there throughout the whole process. And that's the same thing with the AI, right? So like if you are looking at it, everyone's sort of like, what's going on? I'm like, let's peek in this little box here and see what's happening. One, you might try to make it do something different, because like, oh, we don't really like why it's making this decision. So maybe you're going to say like, oh, we should try to change something instead of letting it do its role. The number of parameters, and most AI is a network, a neural network, and there's so many different layers that go into something that to be able to pull it apart is to actually break it down into a smaller, more simplistic model that will end up being less accurate unless if your data is extremely linear, which rarely happens. Anyways, it is kind of less, or more the simplest way I can think of describing it, but something of that nature. Anyways.
Yeah, no, that's fantastic. So, to bring it into the context of finance then, there are actually larger firms that are doing this, but they're using AI as assistant research analysts. And that's probably, and all the experts say, but usually all the experts are wrong, but that's as far as that this is going to go. They'll never take over the job of the research analyst, but they can be the best assistant that you'll ever have. So what they're doing right now is they have these super large data sets of all of the data points that analysts consider. And then the analyst goes in and they're working with data scientists to identify the metrics that they look at when they're looking at individual companies. So they're doing this on the company level. And over the next couple of years they'll be doing this, and they'll be training these models so that they can then go out every day and evaluate your entire universe and let you know if a recommendation has changed based on the way that you think. So in a way, it's taking your brains, but it's multiplying and scaling up the processing power to be able to make recommendations the way that you do. It's never going to replace that person because the accuracy rates, at least today, can range in between about 60 to 80%, but there's only room for improvement. And so that's something, that's one way that they're using AI today in a lot of your sell-side research firms and maybe even some very large buy-side firms.
All right. Yeah. So back to the insurance side of things, we're moving towards using a machine learning model to help us identify more quickly what class you should be in if you are applying for life insurance. So life insurance now, if you make an application, it goes through the underwriting process, or submit an application, you go through the underwriting process, and maybe you'll get put into selected or preferred selected, or maybe you have diabetes and you smoke and you're 65 and some more issues, and you get put into a lower class. So right now it's working towards where the first top 2 or top 3 classes get selected automatically, and you go through the process, and maybe you don't have to have someone come to your house and take blood samples and urine samples and all that extra stuff. So it's less burden on the applicant. And then the lower risk classes are probably still something that insurance companies want to look into to make sure they're being put into the correct class. But this type of model, just as if with AI, what you're talking about, how it becomes your brain a little bit, because for the first, let's say, 1,000 applicants, we go through and we look at their variables and we say, this person would be in this class, this person would be in this class. So then we have our training set. And same way with investments. Like, you go through, like, we would actually make this investment choice. And as those databases of what a human would actually do grow, AI, machine learning models, will be able to become more accurate and more accurate. So when they said it's going to be the best assistant, it wouldn't surprise me in 5 years that it's actually the best research analyst, because the underlying training sets will grow, and people's comfort level with them will also increase. Because that's another big thing I've seen is as we present more and more findings, the ease and comfort with the work that we're doing on our level is definitely improving a lot about. So yeah. Questions?
Kind of Joe, question for you,
Yep.
real world example. Wells Fargo just sold their pension business.
Yes.
I'm curious if Securian took a look at that, and if you have a comment on the price that Principal paid for it.
I'm not sure. So I mostly work with pension programs that give us mortality data that they've already had, and then we adjust our pricing based off of past mortality experience. So I'm not actually sure if
So you didn't see that?
I did not see that.
Okay.
We also are in a different space too. I'm not sure how large it was.
It was big.
Yeah, so we probably didn't bid on it. We were more in like a $100 million to $250 million
Yes, I think it was $1.5 billion.
target. market, so we usually pass on those ones for now. I mean, it's a big risk to take over. I mean, there's the market right now is absolutely booming, so.
Yeah, so is there back to the AI assistant research analyst, is there ever a detriment to adding a data set to like an AI, like say it has like 10 data sets and it's giving you good results, and then you add, you know, 1 or 2 extra, and then it just kind of starts going the wrong way? Is that ever possible?
Oh yeah, for sure. Like, and if the first 10 in your example were highly correlated with each other, and the other 2 are completely correct, but are on a different, or data sets kind of coming at it from a different angle, it could theoretically help the model, but could give you worse results, right? If you keep adding other data sets that are different than your original 10 that were really giving you good recommendations, overall, maybe on a much wider scope, it will become more accurate as you add more data sets like that. But yeah, it could decrease the accuracy just from the original 10, just because those were. It's like running a in-sample model on the data set that it was calculated on. Of course, it's going to do really well because it knows exactly what the optimal decision would be. But as soon as you add 2 more that are different from that, it's a lot harder to continue to be accurate.
So there'd be more risk running the first 10 and, you know, it having a wrong outcome than adding the extra 2 and having worse results in the short run. The long run will be beneficial.
Right, exactly. The risk is that you're just saying the entire future or the next year or whatever your time horizon is going to be exactly like those 10 data sets. And if you're just kind of picking and choosing those data sets, then that's not going to do as well.
Yeah. Good question.
Let's see, maybe each you may be on different, you know, how far you're going down the path of this, but for the most part right now, is it still, you know, consuming the data you have as opposed to, because there's a few places where you talk about external data, where, okay, we need to find something that can incremental our model or add alpha or, you know, another data. You know, how much, you know, do you have a sense for, are you good at analyzing your own data before you can start to go out and play with others? Or maybe if you have a sense where you guys are on that path of being comfortable with where we want to torture our own before we bring in others to torture. Any thoughts?
I have a comment. In my space, I would definitely say that we're middle of the road there. So we are in the process of collecting our data, and we do have decent history back 2 or 3 years, but it's not enough deaths for us as a mortality rates,
Yep.
right? To completely trust that portion, especially as trends. I've done a lot of long-term mortality rate studies, and especially as trends are being affected, especially right now, like opioid crisis and obesity issues. Having 3 years, 4 years of data is just not enough to accurately depict a trend of some sort. So we use our external purchases as not only part of our modeling, but to validate our own information. But also external purchases give you that wider variety. So maybe your target market is middle age, middle like socioeconomic participants or something. But actually you want information on lower class individuals or higher net worth individuals, but you don't have that information to make your model be able to extrapolate to those groups. So then we need to purchase that external data to be able to say, like, okay, I guess that a 60-year-old divorced woman acts like this, but that's nothing like the information that we currently have. So I think for us at Securian, we are definitely in the portion of like gathering our own to be able to do our own analyses, but even at that point, we would want to append extra data just to be able to get the whole market view and not just the segment that we focus on.
I would have to say it might depend on how many data sets you have and what you're comfortable using. So as a FactSet or Bloomberg subscriber, you have a ridiculous amount of metrics that you can pull in and look at. So if you have a vast amount, it might just be easier to just start from a qualitative perspective and say, you know, I've been looking at this stuff for these, 10 core things my whole career. Let's see if those work, right? And then you can do the back test similar to what I have. You calculate those, right? And then you can see if it's statistically significant. We've done that, and we've had varying success. Some things that we've been looking at for a long time, they weren't as consistent as we thought they were, and some things were awesome, right? And so you can kind of narrow it down just a little bit, just get a little bit more comfortable. And then as you think of things that maybe qualitatively in the past you have thought about and now are becoming data sets. So there's like a lot of sentiment data out there, and there's a lot of models that can read 10Ks and Qs and be able to read earnings calls as it's listening to the people, right? And then that all gets pushed out into a data set, and then you're like, well, I've been looking at that stuff, let's test that as it comes out. Just as it's useful and as you think, just because there's so much out there. You can get caught up in a lot of noise. I would imagine only Citadel and World Quant have the quantitative teams in order to analyze everything, and even that would take them several years to do everything that's out there.
And yeah, we're going to be very similar. So we're always looking for new data sets that will provide insight into an investment decision that we're making. But there's a couple things that we consider when we're looking at those. One is making sure that the data set is not a derivative of another data set that we're already looking at, because then that can almost look like new data, but it's still based on the underlying data that you still have over here. And the last thing that you want to do is introduce another decision influencer over here that's based on the beginning data. So that goes back to the understanding what the story is behind your data and what's happening there. And then the other question becomes, when you start to look at introducing new data, what sort of noise does it introduce? So for example, for us, we would probably not utilize a news scraping algo to trade in markets, because we are not short-term oriented with how we try to trade. We're trying to pick up on longer-term trends or longer-term investment type items, as opposed to sitting there and day trading an account and buying and selling, buying and selling. So a lot of it too is understanding what sort of noise do you get with the new data set, because that can always take up quite a bit of time to scrape through the noise.
So two things that sort of are generally concerns in data analytics, and especially when we're talking about machine learning and AI, and sort of AI taking over the role of a research analyst, are scaling up human biases and overfitting. So I'm wondering, what's been your experience with, drawing the line where you say, okay, I think I'm in the realm of overfitting versus I'm comfortable with this model, or, am I scaling up some sort of human decision that may not be accurate?
All right, yeah, I'll go for it. So actually the first item that you said there, the overfitting, right? That's always some type of issue. I think one of the biggest things I look at is making sure that if we do a bunch of different types of breakouts or extra parameters in a model, that none of those bins have less than X amount of deaths or something of that nature. Then also the post work. So you have your model, and then looking at someone in all the different areas. So yeah, there's your fitting criteria, there's a bunch of different measurements that you can do to say, is this statistically being overfit? And that may be, let's say it's not. Let's say it's not statistically being overfit. But it's not you can't extrapolate it to exactly what you want to do. So I think one of the biggest things with AI and machine learning is to continually monitor your outcomes, which is where in the network I had said is a business analyst type of role would come in. So it's making all of these decisions, and then to take a subset of the decisions that it's making and having a human check them. be like, okay, is this actually what we want to be happening? Because you know what if these are working how they're supposed to be working, they should be like, you know, making decisions, milliseconds, whatever it might be, depending your processing power. But take that subset and be like, okay, let's look through these and let's make sure that it's doing the correct thing. Because that's always a possibility, especially with when you're talking about adding different data sets. So let's say you fit your data set, you fit your model with the first 10 data sets, and all of a sudden it's being applied to data sets similar to your other ones. And it starts just like heading in that direction and learning and heading in that direction to make sure that you can pull it back up and someone can see that and be like, okay, why are these prices of these products now becoming $2 when they should be at least $50 or something of that nature? That's an extreme example that could potentially happen on like Amazon because they have neural networks in the background making all of their pricing. If you ever notice, Amazon has said like, oh, you can click and go and buy at the company's, you can go buy at the company at their price. What you don't know is that you click on it and their price, the company's price will actually probably be a little bit higher. Because then they're like, oh, we should buy from Amazon. So you go back and you buy from Amazon. But they have algorithms in their background doing all of their pricing and debating on like what your demographic is. It might actually be priced differently for you. Anyways, the biggest thing, especially with when you're working with people's financial information, is to have that checking, that human checking of your model consistently, which is probably going to be a full-time role or two in itself when the models get built. But if you look at the opposite way, it'd probably be 10, 20, I don't know how many people making those decisions, taking that time every day. So cost benefit there is pretty high.
And also on overfitting, I mean, the 60 to 80% accuracy that I quoted earlier, that was out of sample. So, and like I said, the 60%, I mean, and it's all right. Definitely room for improvement. There are, and that's kind of like the biggest roadblock to it becoming the full research analyst, that, you know, you could just have someone who starts their own company and then just buys a bunch of AI products, right, and then now they have an army of research analysts and they go out and they do. I think it'll be a long time before we see that, if we ever see it, just because you need some human that's looking at this and saying, does this outcome make sense? And so, yeah, there is danger to that, and there's also danger to scaling up human biases, especially if we're all buying the same AI products, right? If they're all making the same recommendations, I mean, you'll see another, you know, tulip boom somewhere, but it'll be, there's danger in that, but I think there's also processes in place that you can put into your own models to counteract that. So, for example, momentum is just a fancy word for a factor that's basically hurting, right? If you can get the performance of that factor and have that as like an indicator to say, you know, maybe this might be overbought, and then make that recommendation to sell after that, that might be a way to curb that in your own model against the AI that everybody else is using, saying buy, because this thing's going off the chains.
Yeah, you guys touched on it. So I think that's the interesting part about it, is theoretically if you took equal algorithms and you put them out into the market and just let them go on their own, what you'd probably encounter is a market environment that maybe has a lot more quick run-ups and then crashes and flash crashes, those sort of things, and then quick recoveries afterwards, and you'd see the velocity of markets change with their behavior and the way that they are operating, theoretically, if you just put them out and let them go without any leashes. So that was getting back to the very first point that I wanted to make with AI, is you have to have some sort of overview of this, or making sure it can't just be a go off in the corner and have fun sort of thing. So
it also won't surprise me if there's going to be a lot of government regulations around the use of AI at some point. Because I mean, that's huge. Like even genetic testing right now, which is modeling and moving towards machine learning type stuff, there's tons of legislation either in the works or already implemented for health insurance, but now it's moving into life insurance. So I'm sure as we move towards potentially using AI in a type of investment situation, that government regulations or government legislation is going to start popping up, and who knows what will happen with that. So.
One more?
I can, maybe a good question to finish on, but are there any additional resources you guys would recommend for someone who's in novice this space? Like whether that's a course online or some sort of book? That would be good.
It might depend on the depth. If you're looking to get into the field, there are tons of like courses that will teach you. And the language you probably want to learn specifically for machine learning and AI is Python, I imagine. You guys would agree with that. Tons of courses out there. I mean, you can look at YouTube videos on it. But in terms of just learning about it, a lot of college computer science courses are offering something on that, so you could go back to your university and just take that sort of class. But I think there's also, like World Quant has a World Quant University, and they can, and they like take you through all of that. You can do like an 8-week training program and then a 2-year master's in science, Master's of Science in Financial Engineering. That will do that too. So it depends on the depth that you're looking for. I mean, if you're just kind of looking for a brief like primer or something, so your local sell-side analyst will be able to provide that for you. Otherwise, you can most likely find just a book, but I don't have a specific recommendation.
You want to move into data science? Data camp, R for data science, both good ones, or any type of Python course. Because I mean, I use R, but I'm not anti-Python, so some people are. I think you should use whichever is best for you in your company.
I think that's the nice part, is that there's a lot of good free resources out there, but then there's also a lot of good resources that cost money, but those are good as well. So World Quant University is an interesting one because that's a free program, I'm pretty sure.
Yes.
So obviously you have to apply to get in, but if you think about getting a master's degree,
Free ain't bad.
Yeah. So, and that's a perfect segue into the Python. I believe the CFA has an upcoming thing, don't they?
And before we do that, help me thank these 3 people.